The hard right edge is currently trading at 1900 roughly, bouncing up and down today. So we're going to actually go back and I'm going to give you a really clear way where you can identify these market trends so you can tell if the market is going to be more bearish today or more bullish. We're going to go a long way back so we can really drill into this. Picking a random point in the chart, let's start moving forward. What we're looking for are the peaks and the valleys. Basically, when you get a high peak and then you get a lower peak and a lower valley, that means that the general trend is down. We'll start by the easiest way is just outlining these. We'll start here. We had a peak and then the market started to go down. When it made a valley or a V formation here, we'll mark this off again. The market rallied where the bulls wanted to push the market up past its previous high, but they weren't able to make it. So we ended with another peak. So this is a high and then a lower high. We have our low, and then what we got again was another valley here, or a lower low. A lot of times when traders are trying to get into positions, they start seeing the market rocket down and they would just want to hop in. You often can avoid that though, because the market will pull back up. The market is not a one-sided event. You have buyers and sellers. For every seller, there's a buyer. So when the market starts getting pushed down, people start seeing that as a value. The bulls think the fact that, wait, this is such a great price for this. Why don't I get in now and then I can ride it up to its previous high? What happens here though, on this next lower high, is the fact that the bulls who are charging the market up get stopped. And they realize this. And it's very important the fact that they got stopped at a lower high than the previous time they rallied the market. What this proves to them is the fact that they're losing strength. In a success of 1, 2, 3, they've lost strength every single time. And the bears have won out 3 times in a row now, forcing them down. So what do you end up with? A sharp fall down in the market, followed by another valley. This is again really important because we see we have 1, 2, 3 lower lows. Again, even if you want to get into the market here, you don't need to, and you can often wait for the market to pull back up. Because the bulls will not just give up on this market. They're going to want to keep continuing to add onto their positions because in the end, a bull has a mindset that the market will go up eventually. So yet again, they rally and they create another peak. But you'll see, just like with the previous ones, we have again a lower peak. This is really important because yet again, they've been forced down in the market. And once they realize the fact that they can't push the market up and break one of these higher peaks, the market gets pushed down yet again to create another lower low. Now here you see a more substantial rally from the bulls. They push the market back up again, but because they've gotten hit so hard, even though they do move the market up to a peak of 2075, from a low of 2061, it still doesn't break the previous high right here. At this point, any bull who is seeing this is seeing a consistent downtrend in the market. It creates a lot of fear in them, and then it often will result in panic selling, as you'll see here where the market just falls down to a new lower low. This is followed by another rally to create a new peak, and then yet another lower low, because that new peak again was lower than the previous. You have to put yourself in the mind of a trader when they're going long and when they're going short. A lot of traders only choose to either be bullish or bearish. They only trade either long or short. It's good to have a mindset where you're open to trading either long or short. You have to be able to take a look at whatever position you're about to take and say, if the market was flipped upside down, would I want to take that same position? If it was a short position, flip the market upside down, would you still want to take that position if it were a long position? It's good to be on both sides of the market because you have the most freedom and flexibility. When we're actually dealing with this on the right-hand edge, I'm going to be drilling down into 15-minute charts to get better entry prices, because trading on the 60 can be extremely expensive depending on your account size, and the 15-minute can give you very similar signals, but just micro-tuned so you can pick perfect entries. Here's where we got our first reversal, where on this day the bulls were able to push the market past this previous high. Now you'll see this quite often when a long trend like this has been continuing down. Anyone who started out here with a short and continually moved their stop down every time a new peak was made, so their stops would have started up here outside of the high and then moved down when this peak formed to here. When this peak formed, they moved their stop down, and since they short sold, they're now continually in the money. They're just trying to protect their profits. When they got a new peak here, they moved their stop down to here, and that kept them in even when this market pushed up here. But they decided to move their stop down here and then waited for the market as it rocketed down. And then again, when the market made another peak, they moved their stop down to here. Now this is a really key time. After a long time of the market continually making lower lows and lower highs, a lot of stops are going to be right in this area. So as soon as this level is broken, people that are just taking profit, not so much even taking long trades, but only protecting their short trades profit, will have their stops here. So you can have a lot of quote-unquote forced buying. People here don't necessarily think the market is going to be going up, but their stops are being triggered. So this acts identical to like buyers coming into the market, adding onto their positions.